video, I will explain how you can earn passive income through S-REITs even in today's high interest rate environment. By the end, you'll know exactly how to analyze and pick winning S-REITs that can potentially give you returns of 6.8% per year. Let's dive in. Hey friends, welcome back to the channel. I am Iggy here, and I've been covering topics such as stocks, finance, CPF, and everything related to growing your wealth in Singapore. The investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've covered over 600 videos and over 280,000 watch hours as of November 2024. Right now is actually an interesting time to look at S-REITs. The FTSE ST-REIT index is currently trading at 642.87, down about 1.09% from last month. This means many quality REITs are trading at attractive valuations. In fact, the S-REIT sector is trading at an 11% discount to its fair value, with an average dividend yield of 6.08%. Think of S-REITs as a way to own a slice of Singapore real estate without buying an entire HDB flat or condo. When you invest in an S-REIT, you're buying shares in a company that owns and manages real estate right here in Singapore. The total market capitalization of S-REITs currently stands at $86.34 billion. S-REITs must pay out 90% of their taxable income as dividends to shareholders. This means you get regular income from your investment, just like collecting rent from a tenant. The best part? You can start with as little as a few $100s, unlike saving up for a condo down payment. Let me break down the main types of S-REITs and how they're performing in today's market. Commercial S-REITs. Take Capital Land Integrated Commercial Trust, for example. In the first half of 2024, they achieved impressive rental reversions of 9.2% for retail and 11.7% for office properties. Industrial S-REITs have been particularly resilient, with Maple Tree Industrial Trust showing strong performance. Healthcare S-REITs like Parkway Life REIT have managed to increase their DPU by 2.8% year on year. When analyzing S-REITs, focus on these key metrics. The industry average gearing ratio is currently 39.60%. I prefer REITs with gearing below 40% as mandated by MAS. Be cautious of REITs with gearing ratios above 50%. For price to NAV ratio, the most overvalued REITs currently include Keppel DC REIT at 1.61 and Parkway Life REIT at 1.56. Meanwhile, some REITs are trading at significant discounts. The sector average distribution yield is currently 6.08%. However, don't just chase the highest yields. Look for sustainable yields backed by strong operational metrics. Let's dive deeper into the key metrics you need to analyze before investing in any S-REIT. Traditional metrics like PE ratios don't work well for REITs, so we'll focus on industry-specific measurements. FFO is the most important metric for evaluating REITs. It shows the actual cash flow from operations by taking net income and adding back depreciation and amortization. Think of FFO as the real earnings power of a REIT's properties. For example, if a REIT reports net income of $50 million but has $20 million in depreciation, its FFO would be $70 million. AFFO takes FFO one step further by subtracting recurring capital expenditures. This gives you an even more accurate picture of a REIT's ability to pay dividends. It's like looking at a landlord's income after setting aside money for regular maintenance and upgrades. NAV helps determine if a REIT is overvalued or undervalued. It's calculated by taking the market value of all properties and subtracting liabilities. When a REIT trades below its NAV, it might be undervalued. Currently, some S-REITs are trading at significant discounts to their NAV, presenting potential opportunities. High occupancy rates indicate strong demand for the REIT's properties. Look for rates above 90%. For example, Capital Land Integrated Commercial Trust's 96.4% occupancy rate shows strong tenant demand. WALE shows the average remaining lease term across all properties. Longer WALE means more stable income. A WALE of 5 to 7 years is generally considered good for commercial properties. Check if the REIT relies too heavily on a few major tenants. A well-diversified tenant base across different industries provides more stable income. The gearing ratio shows how much debt the REIT is carrying. MAS caps this at 50%, but conservative investors should look for ratios below 40%. Higher gearing means more risk, especially in a rising interest rate environment. The interest coverage ratio measures how easily a REIT can pay its debt interest from operating income. Look for ratios above 4x for safety. Check how the REIT's debt repayments are spread out. Well-staggered debt maturities reduce refinancing risk. Avoid REITs with large chunks of debt coming due in a single year. Track the DPU growth trend over time. Consistent growth indicates good management and healthy operations. While the sector average yield is 6.08%, don't just chase high yields. Compare yields within similar REIT categories and check if they're sustainable based on the REIT's AFFO. Same-store net operating income growth shows organic growth from existing properties, excluding new acquisitions. Look for REITs with clear growth strategies, whether through acquisitions or asset enhancement initiatives. However, make sure they're not overpaying for growth. Here's my three-pronged approach to S-REIT investing. First, focus on REITs with strong sponsors. A good example is Parkway Life REIT, which recently expanded into France. Second, look for REITs with high occupancy rates, like Capita Land Integrated Commercial Trust with 96.4% portfolio occupancy. Third, consider the debt profile. REITs with well-staggered debt maturities and higher fixed-rate borrowings are better positioned to weather interest rate volatility. S-REITs offer a compelling investment opportunity, especially at current valuations. If you found this video helpful, hit that like button and subscribe to the channel. Next week, I'll be covering the top 5 S-REITs that I believe are poised for growth in 2024.